All right, you have to follow me on this. This is the numbers on the left here are $1 trillion in debt and 16 trillion. That's what it looks like when you put all the zeros at the end of it. It's a pretty big number, and again, hard to understand. If the federal government generates about 42% of its revenue from individual taxpayers. There's another 42% that's generated from payroll taxes, roughly 9% comes from corporate income taxes, and then there's another 9% or so with various different fees and other income items. If we agree that the revenue that's going to be generated to pay this deficit and this debt is going to be done in that same percentage, we have 42% that's going to be attributable to individual income tax. The deficit for those individual taxpayers is $457 billion and $6.7 trillion of debt. There's 137 million taxpayers that paid tax. So if we spread that obligation equally out across each of those taxpayers, every year the government is borrowing on your behalf $3,315. You have $49,000 of debt, and the average income of an American taxpayer is $56,000. And remember, when we're talking about this, there's more than 137 million Americans. These are taxpayers. This is people that file tax returns. It doesn't include people that do not have income and aren't required to file returns. If we look at the top 1% and we take this a step further and say that, on the previous slide, 36.7% of all income taxes is paid by that group. And if we jump to the conclusion that they're going to continue to pay at that level and not increase it as the government is suggesting, the share of the deficit and the debt then is $167 billion and $2.5 trillion of debt. On a per taxpayer basis, for that top 1%, the government is borrowing on your behalf each year $122,000 of new debt. And your share of the debt that needs to be repaid is $1.8 million. And the average income in that group is $959,000. The last column shows the 5%, goes through the same calculation. The government's borrowing about $39,000 a year. Your share of the debt's $958,000, and average income in that group's $359,000. So I think this illustrates and puts it in an easier to understand number when it's broken down to the per taxpayer basis. Outlook going forward. The top line on this schedule, this is published by the Congressional Budget Office, shows the revenues and outlays as a percentage of gross domestic product. Now keep in mind, if we're in a recessionary period and GDP drops, then the spending increases as a percentage. If we have a boom, we have fantastic growth, GDP grows, then the spending decreases as a percentage. We can see the darker blue line on the top in most cases has been higher, so spending's been higher than the revenues brought in, except for a short period of time in the late 1990s where we did have budget surpluses. And as we get over to just after 2006 and we see the two lines move apart drastically, that's where we moved into a recession. Tax revenues decreased significantly and spending increased with stimulus spending dramatically. So those two lines move apart, and the difference in between is new debt that was being created, and that's a large part of our debt currently. The scary part when you look at this is those lines aren't coming back together. They're starting to move out together and somewhat parallel, but they're certainly separated, and they're moving and increasing. So the projections for the spending going forward as a percentage of GDP is increasing and really moving to historically high levels. So either we have some drastic spending cuts, or we're looking at a much, much higher tax base that needs to be generated somehow. So the question is, where does that come from?